Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Prateek Agrawal of Motilal Oswal. And remember, we've got a bit of a scare day before yesterday. I think the markets have digested the near-term scare very well. But the conversation with Prateek, while we talk about the monthly outlook, is not just about the here and now, but how he thinks about the slightly medium term. Prateek, great having you. Thanks for taking the time out.
You.
Prateek, how do you look at what's happening now that we are beyond 20,000, sitting atop there comfortably, and scares or dips are kind of getting bought into almost immediately?
Yeah, so one way to look at it is we are at sustainable levels, but going forward over the next few years, one should expect a tad lower than earnings growth in terms of return expectations. Earnings growth, by the way, should be strong. Over next 2 years, we believe BSE 500 could do a 17% kind of earnings CAGR as per consensus today. Maybe we shave off a percent or two. So growth in earnings is strong. From that shave off, let's say a percent, and next 2-3 years, that's the kind of compounding we expect the market to do. A tad lower than earnings compounding to adjust for the valuations, which may have gone a tad over sustainable levels just now.
Um, I believe one of the key things which helps sustain this earnings growth is that the policy moves or the policy direction is firmly in favor of growth.
Oh, yeah. So that is something we have been talking about. Frankly, I was a tad late in recognizing this. The world changed from the bottom of COVID. The move up in the market that we all saw and did not understand was because of very large changes which was happening globally. So if you go back in time, we were opening our markets to foreign competition. Globalization was the mantra. Lowering import duty protection was what was happening. And in that context, if an industry took roots in one part of the world, there was no way that somebody else could make it move. COVID changed that, uh, and world thought that versus sourcing everything that is manufactured from one location, let's have multiple locations. Maybe a lot of it within each country as well. So every country in the world now wants higher part of critical manufacturing. And in some sense, that is pulling back globalization across the world. And that gives policymakers a lot of elbow room. So we have seen duty protection come in if our industry is getting impacted. Make in India, which was there before, but floundering, I would say, it's now getting a lot of strength. Industry after industry is finding feet wherever there is a damage, potential damage. Government is coming in and lending a helping hand. There are PLIs being rolled out sector by sector. There is defense indigenization list after list comes out, and so on. China plus one continues, so which is a global thing. We are trying to get our piece of cake there as well. So I think in terms of growth, policy making is very, very supportive. I think even the monetary policy is pro-growth. So in this round of monetary policy tightening, we have seen us lag the West by at least 25 pips every time the West increased interest rates. And we paused before the West did. And the whole thought is if our forex reserves stay good and healthy, the elbow room with monetary policy makers would be higher, and we could continue to see sustained rates even if the West increases interest rates. So, see change there. I think it continues. If one draws a parallel, it's actually better than what happened between 2003 and 2007. It is much more broad based and with much higher certainty of payback of capex that one puts in just now.
That's a tall statement, Prateek. But you're centering in on this particular manufacturing piece as of now, that it is broader based and a better payback, right? Are you sensing that the euphoria around equities is also similar or better than 2003 to 2008?
No, 2003, so it started very slowly. It gained momentum as we went forward. Uh, so, on the larger cap indices, they are, like I said before, only a tad higher than where they could be. So either you adjust 3-4% in the near term, or you say over next few years expect some bit lower than earnings growth. As you go lower, maybe mids are a tad higher, small are a tad even higher. Uh, Small point that I want to make is that if the policy framework continues in this manner, next period high, whenever it happens over next 2-3 years, once again the mid and the small spaces could end up delivering better returns. If you look at actually longer period, mids and smalls haven't done as well. From a 2018 peak in smalls, we have seen a 15% kind of a valuation correction versus other spaces. So in terms of valuations versus the earlier peak, we are way lower. What is giving strength to this space after a long while, after 12, 13 years of underperforming, is the revival of manufacturing. So as you go smaller cap, the manufacturing part of total value add is very high. If manufacturing continues to see a renaissance, you should expect this part to continue to bubble up. Markets being markets, they can move higher than where they should be, and similarly undershoot on the downside as well. And hence, I was making the point, let's say next time market hit a high a few years hence, if the policy environment remains as good as it is today, manufacturing starts to gain market share as a part of GDP. That's a reversal. We were losing market share there as a part of GDP in manufacturing. Now it's a reversal. So I think the mids and smalls would end up delivering better than other spaces.
Prateek, I wanted to talk about a lot more, but I want to pick up some themes out of what you just mentioned and probe that a little bit more, because you've seen various such cycles. To the lay eye, to a person like me who's watching it from the distance, it seems as if a clutch of areas are coming up with the government support, in some cases even without the government support. What you would have expected some of this to happen, but what is it that has surprised even you when it comes to the strength that comes in within this manufacturing space?
No, so if I take a space, I think I was very, very skeptical of the EMS space. When the first few companies happened, said, screwdrivers technology here, and we are giving that kind of a multiple to this piece of the market. But then once you start to understand the longevity of growth and start to see the ecosystem getting developed. First time PLI in electronics happened, there was a huge debate, and at that time I was in the earlier office as to whether it will sustain beyond the 5 years of PLI. The time just seemed so short for rest of the manufacturing backend ecosystem to develop. But now it is developing. So from a PCB board integration, now people are going into manufacturing PCB board themselves. There are foreign companies coming in to do at least semiconductor packaging. As yet, we are not making the wafers, but given that everything else is falling in place, maybe that could be the next step. So, seen some facilities, seen some, how they are scaling up. I think that definitely changed the outlook there. I think here experience really hurts. We have failed so many times in the past that you take that much more time to believe that this time it is for real and it is happening.
Yeah, well, can imagine something like that happening too. Is that the same phenomenon that could be uh, keeping some investors at bay when it comes to railway stocks, for example, which have had a terrific run, and there are still naysayers who believe no, but companies are talking about some fairly strong numbers, or for that matter, defense, wherein you've been an early adopter, but not everybody is still piled on.
If one looks at various spaces, I think one space where we see continued longevity of growth is defense. Uh, Now, railways today is a space which is showing higher growth. It can continue for a longer while, given that one-day trains will keep rolling out. There is like 400, 600 trains that will happen. Complete overhaul of the system, and then it will have to be followed with tracks and so on. So, while one-day can do 170, 180, tracks don't permit that. So, this thing would have to be changed. So it can be long term, but then one has to be cognizant of the space in the budget as to how it moves. So a good way, to my mind, is to look at uh, uh, companies whose product go into various spaces. Well diversified capex companies. So the thing is, capex as a theme is very strong. Today it is railways. Tomorrow it could be some other space. If a company has capability to service various spaces, I think that becomes easier.
Okay. But you're constructive defense even now, right? Because you were constructive 6-12 months ago when we spoke, and you spoke about some companies doing some very niche things.
Yeah, so niche things, I think we ended up understanding this space. Yes, valuations have moved up, but uh, the outlook has become better. So my sense is valuations stay supported. Uh, Now, earlier, the whole thought was India opportunity. I think India opportunity itself is expanding, uh, and some export opportunity in some spaces may be emerging. Some civilian opportunities in some spaces may be emerging. Earlier, there was huge amount of skepticism towards that. Now, I think that skepticism is reducing. I think interesting space. I think a lot of the outperformance, the huge outperformance that you saw may be behind us, but I would say it's still a space which could continue to outperform the indices as we go forward.
Okay. Just
So
one.
not in the large manner.
Not in any large manner. Okay. What about um, what about potential downside risks, if you will? Because a few people that I've spoken to in the recent past cite this whole B2G or the PSU nature in select names in defense as well as being a key hindrance, saying that this tape has played over multiple times and you will see some bit of issues because government cash flows, government contracts are not necessarily always the most dependable. Is it different this time? What gives you the confidence?
No, so that fear one should have in the mind. Okay, and hence in a portfolio there can be only that much allocation. That said, we do believe it is slightly different this time because, and you can speak to some of the defense guys. In the past, we saw a sustained decline in defense as a percentage of budget. And the thought was diplomacy is very effective. We will talk and sort it out. We don't need to invest so much in equipment and defense. So in terms of capabilities in many spaces, we would have fallen below that existing in our neighborhood. I think those gaps are now getting filled, and along with the thought that we now need to manufacture more inside the country. So if we look at a transition of China from 2006-7 to now, from being one of the largest importers, they are now one of the larger exporters. If we say we are 14, 15 years behind, even if we are that much behind, should we not be making the same transition? And that then gives you a pretty long runway of growth. The other thing is, yes, they are PSUs, but what I understand is there is a very close monitoring that is being kept as to what things are getting delivered, what capacity is getting free, and can it be quickly be put to use again. Capacities are being expanded uh, almost across the board. So be it in the aerospace space, be it in the naval space. So and the close track that we feel the policymakers are keeping on what is getting free, I think takes care of a large part of an investor's anxiety. Earlier, I think that was not the case. If something was getting free, the management would then have to scout around, look for something else to fill that space, bid, and all of that. Now I think it is being observed. This space is getting free. What can we do next? No, not only from the company side, but also from the policymaker side, from the government side. Very different.
Interesting. Okay. Prateek, what about starting valuations? I mean, these promises or the prospects of, say, for example, some of the EMS companies. I mean, people always used to talk about Dixon, but even the others, Keynes Tech, some others are all trading at valuations which are very expensive, even FY26 odd, right? So how do you then either keep the money in those stocks, looking the starting valuations, or buy them afresh? What is the argument there?
And also, we are invested in that space. It is or could be the highest growth in EPS space for a long while. If you forget China, forget Malaysia, even if you look at a Vietnam, that country from a zero is now, I think, $100 billion in that space. So we have just started to move up. So if we do it well, the longevity of growth can be very long. And in this ecosystem, if somebody can backward integrate, forward integrate, the use of that entity to the end buyers increases. So we are seeing some bit of that also evolve. I think this space is very similar to IT companies in 90s. Okay, is what my sense is, except for that IT companies then had very high ROCs. 50-60% was the usual, and they could grow very strongly without dilution. EMS companies have very strong growth trajectory ahead of them, similar to IT companies. 40-50% kind of growth can sustain for very long. IT then was doing 100% is another matter. But here ROCs are not very high.
True.
So most companies are below 20%. Now they say that with better inventory control, they will go over 25, but even they say over 25 only. So that is the aspirational number. IT, the worst company, would be doing more than that. So that has to be kept in mind. So these are companies, if they continue to grow in this manner, will have to keep diluting equity, is what my sense is. So valuations will hence have to be a fraction of what IT valuations were at theirs in that period.
Got it. Okay. Fair point. Since you brought about IT, I'm tempted to ask you about consumer tech, because you guys have taken, I believe, some concentrated bets there in the consumer tech space or the internet businesses. What is the thought process there?
No, so like I said, we are high quality, high growth focused house. That is how all of our businesses are focused. So we spoke EMS, we spoke some other spaces, all high growth. Okay, If you want non-linear growth, then you need to start to look at platform companies. You may call it new tech. And we have opted to be with companies where they were already making a very strong transition from let's say an EBITDA loss to an EBITDA profit. It helped that the street is still skeptical, and that has helped good, thank God, but good price discovery for ourselves. Uh, Look at some of these businesses on incremental sales and the incremental change in EBITDA, and then one starts to understand how rich the incremental business is. And well, 2 years hence, 3 years hence, the incremental business today would be the bulk of the business. So if one plots, this is where it could be after a few years, and then see what kind of valuations one would end up ascribing. I think, and while the growth continues to be way higher than similar brick to mortar businesses, brick and mortar businesses. So our sense is there is still money to be made here. We in our notes have said these are good businesses. Some of them, not all of them. Good businesses, good valuations. We stick to that even now after a strong move up. But maybe they have very low ownerships of promoters. A lot of it is private equity. So that change in hands may cause some amount of volatility. So that one has to be conscious about while building it in the portfolios.
Got it. So net, Prateek, before we thank you, don't necessarily look at the index. The index may consolidate. A quarter of consolidation might actually help valuations, but look beyond the index for high growth pockets.
So, just make a point there. So we say this is time for alpha. We have said it in each one of our write-ups and videos that we roll out from November of last year till now. We say this is time for alpha because after in 2008 to 2020 period, 21 period, after 14 years, when actually the mid-cap index grew earnings lesser than the large-cap index. So if growth in earnings drives valuation, you go out of a large-cap space to a mid-cap space, you are headwinded. Now, post 21, that is the change. Now, you are seeing mid part of the market delivering higher earnings growth versus the large, while large is also doing well. Okay, till it sustains, I think it is time for alpha because alpha versus nifty. Because when you go out of a larger cap business, where you are going is tailwinded. You get higher earnings growth.
Got it. Prateek, informative and insightful. Thank you so much. Didn't expect anything less. Thanks for taking the time out and being with us today.
My pleasure. Thank you.
Thank you. And viewers, thanks for tuning into this very informative episode of Talking Point.